Welcome to the Deep Dive, your shortcut to being well informed. Today we're digging into Opendoor Technologies, ticker symbol OPEN.
hmm
Is this company a genuine AI-powered disruptor, poised to redefine how we buy and sell homes?
hmm
Or is it maybe more of a capital-intensive value trap, kind of caught in this speculative frenzy we've seen?
That's really the core question, isn't it? And it's what we're here to answer for you.
Exactly. By the end of this deep dive, you'll have a crystal clear understanding of Opendoor's business, its pretty turbulent journey, and what the latest data this is as of July 30, 2025 suggests about its future.
Yeah, Opendoor, often hailed as the pioneer of the whole iBuying industry. They promise to revolutionize home sales with, unprecedented speed and simplicity.
Simple promise, maybe not so simple reality.
Exactly. Its journey has been anything but simple, right? Marked by significant losses, but also this dramatic recent stock rally. So we're going to pull back the layers, look at everything from its business mechanics, its management, to its financials, market perception, and all those inherent risks. And this is timely stuff. It comes just days before their highly anticipated second quarter 2025 earnings release on August 5th.
Which Wall Street is watching like a hawk, a critical test.
Absolutely. The consensus forecast is for a loss of about 0.04 cents per share, which is actually an improvement from last year. But the real focus, I think, will be whether they hit their guidance for positive adjusted EBITDA. That's the thing.
Okay, so to give you the clearest picture, we've structured this deep dive into two distinct parts. In part one, we'll decode Opendoor's core business model, evaluate its leadership, and then dive deep into its financial health. Then, in part two, we'll shift our focus to market sentiment, analyze its ownership structure, and conduct a comprehensive risk assessment before wrapping it all up with our synthesis and a concluding outlook.
And speaking of those earnings.
Oh yeah, good point. Remember to stay tuned to Stock Analytics AI.
Yeah.
We will be covering Opendoor's earnings release literally within minutes of it hitting the wire on August 5th. We'll give you that immediate analysis.
Definitely worth tuning in for.
Part 1, Chapter 1. The Business of Instant Offers. Decoding Opendoor. Okay, let's unpack Opendoor's fascinating business model. They position themselves as, well, the founder and market leader of this iBuyer industry.
Right.
Imagine selling your home without the usual hassle like no showings, no strangers walking through your house constantly.
No agonizing negotiation.
Exactly. And no risk of the deal falling through at the last minute. That's Opendoor's core promise: simplicity, certainty, and speed.
And for many homeowners, especially, in fast-moving markets or when they need certainty,
Yeah.
that package of convenience is incredibly appealing. Makes sense.
Totally.
But what's central to their approach is that while the concept sounds simple, the operation behind it is incredibly complex. Opendoor uses this proprietary technology platform, right? Powered by sophisticated data analytics and machine learning algorithms.
The AI part.
The AI part, yeah. To provide homeowners with these near-instant all-cash offers. Once an offer is accepted, Opendoor actually buys the home, takes it onto its own balance sheet as inventory.
Which is a big deal, holding all that inventory.
Huge deal. Then they perform some light repairs, get it market ready, and then they relist it. Over 95% of their revenue comes directly from these home sales.
Okay. And they charge fees, too.
They do. They charge sellers a service fee, typically around 5% to 6%, which is, interestingly, pretty competitive with traditional real estate agent commissions.
Huh. Okay.
And beyond that, they've strategically built out this whole ecosystem of ancillary services like in-house title insurance, mortgage origination through acquisitions. They're aiming to capture more of the overall real estate value chain from each transaction. Smart move if they can make it work.
Makes sense. And their product suite, it seems like they offer a bit of flexibility for sellers.
Yeah, they do. Their flagship offering is Sell to Opendoor. That's all about maximum speed and certainty, giving you that all-cash offer typically within 24 to 48 hours.
Wow, fast.
Very fast. But they recognize not everyone prioritizes speed above all else, right? So they also offer List with Opendoor. This option lets sellers list their home on the open market with a partner agent, trying to potentially fetch a higher price.
But they still have that safety net.
Exactly. They still have Opendoor's cash offer as a reliable backup. And more recently, they launched the Opendoor Marketplace. This is a newer, capital light initiative.
Capital light meaning?
I mean, it connects sellers directly with institutional buyers. So Opendoor earns a fee without actually using its own capital for the home purchase. That significantly reduces their balance sheet risk. It's an interesting evolution.
Yeah, definitely less risky for them.
Yeah, it's important to put Opendoor's scale into perspective. While the U.S. residential real estate market is, well, It's multi-trillion dollars, truly massive.
Here.
The iBuyer segment itself is still quite niche. Historically, it's only accounted for about 1% of total home sales.
Only 1%, wow.
Yeah, tiny slice. But within this specific niche, Opendoor is undeniably dominant. They're the largest iBuyer by a significant margin, operating in over 50 metropolitan areas.
And their position got stronger when others left.
It really did. Their leadership position was solidified after major institutional competitors like Zillow Offers and Redfin exited the iBuying business back in 2021 and 2022. Both basically said it's too volatile.
Okay.
Just to give you a sense of volume, in the first quarter of 2025, Opendoor purchased about 3,600 homes and sold just under 3,000.
So the iBuyer industry's growth is really intimately tied to the overall health of the U.S. housing market. That makes it inherently cyclical, doesn't it?
Absolutely. It thrives in stable or, ideally, appreciating markets with high transaction volumes. And especially in those more homogenous sort of cookie-cutter home regions, think many Sunbelt cities where their pricing algorithms tend to be most accurate.
Okay, but that immediately raises a critical question. What happens when the market isn't stable?
Right. And that's the fundamental vulnerability, isn't it? The iBuyer model has this profound dependence on Federal Reserve monetary policy. When interest rates rise, like they did sharply in 2022,
Yeah, that was brutal.
the housing market can essentially freeze. And this hits Opendoor from both sides. The supply of homes they want to buy dries up because people don't want to sell and lose their low mortgage rate.
Right.
And the pool of potential buyers for the inventory they do hold shrinks dramatically because mortgages become so expensive.
And their own borrowing costs go up too.
Exactly. Higher interest rates directly increase their cost of capital, making holding all that inventory much, much more expensive. You could argue the Fed's decisions are the single most critical external factor for Opendoor's success or failure.
So, looking at the competition, it's interesting how the direct iBuyer landscape has basically become this near duopoly.
It really has. Opendoor's only significant direct competitor now is the much smaller OfferPad.
But stepping back, the broader competition is still vast, right?
Oh, huge. You've got hundreds of thousands of traditional real estate agents, plus the big tech platforms like Zillow and Redfin. Even though they aren't iBuyers anymore, they still command enormous consumer attention when people start looking for houses.
Yeah, they dominate search.
But we also can't ignore the regulatory environment. The real estate industry is heavily regulated, and as a disruptive model, iBuying could definitely face increased scrutiny down the line.
Like specific rules for iBuyers.
Potentially. Some jurisdictions are already considering specific legislation, and there's a unique risk stemming from Opendoor's black box pricing algorithm. If there were ever findings of algorithmic bias, meaning the algorithm unintentionally disadvantages certain groups,
Oh, wow.
that could lead to significant legal, financial, and frankly, reputational damage. Big risk there.
But despite those risks, the barriers to entry in this market seem pretty high.
They're formidable. You need massive capital, literally billions, just to hold inventory. You need proprietary tech and data, which takes years of investment to build accurate, automated valuation models, or AVMs, and gather those vast data sets.
Right.
And finally, you need economies of scale, negotiating better rates with contractors, managing centralized functions efficiently. Opendoor clearly benefits from being the first mover, that significant brand recognition. And while the theory suggests economies of scale in things like renovations and processing, their most critical unique asset is probably their proprietary tech stack, especially that AVM. That vast data set they've built over the last decade continuously refines this core capability.
But you mentioned something interesting earlier, no real network effects.
Yeah, that's right. For all its tech prowess, Opendoor's model doesn't really benefit from significant network effects, where more users make it better for everyone, or strong customer switching costs.
Meaning I could just get quotes from everyone.
Exactly. A homeowner can easily get offers from Opendoor, OfferPad, maybe talk to a traditional agent all at the same time. That limits their customer stickiness.
Chapter 2, management evaluation. Okay, so with such a capital-intensive and, well, highly cyclical business, who's actually at the helm? Understanding the leadership seems critical here.
Absolutely. And the story of Opendoor's leadership involves a pretty significant transition. They moved from being a founder-led, hyper-growth-focused company,
The classic Silicon Valley model.
right, to a much more operations and finance-focused approach now.
Led by.
Led by CEO Carrie Wheeler. And her background is really key here. She was appointed in late 2022, right in the middle of that housing market downturn.
Timing.
Yeah. And she's not your typical tech visionary founder type. She was previously Opendoor's CFO. And before that, she spent over 2 decades as a partner at the private equity firm TPG Global, specializing in consumer and retail investments.
So finance background, operations focus.
Exactly. Her leadership style appears remarkably pragmatic, very focused on financial discipline. Her clear aim seems to be proving that this iBuyer model can actually be sustainable and eventually profitable.
And how's her track record looking so far? Especially given she came in during a crisis.
Well, you evaluate it by how she responded to that crisis she inherited, right? During that 2022 housing crash, Opendoor was caught holding billions in inventory whose value was dropping fast.
Nightmare scenario.
Total nightmare. Wheeler's response was swift, decisive, aggressive inventory liquidation, sell it fast, even at a loss, to preserve capital. Significant layoffs across the company, tightening their home buying criteria to reduce future risk, and a clear shift in focus towards improving the economics of each individual home sale.
Sounds like crisis management 101.
It was. And this pragmatic, some might say ruthless strategy is widely credited with steering the company through what really could have been an existential crisis.
Okay. And more recently, there was that NASDAQ delisting threat.
Yeah, in May 2025, their stock price dipped below $1, threatening their NASDAQ listing. Management under Wheeler initially proposed a reverse stock split to fix it.
Which investors usually hate.
Generally, yes. But then, following that recent speculative rally that pushed the price back above the threshold, they strategically adjourned the shareholder vote on the split until late August 2025, basically buying time, potentially avoiding a damaging split altogether. Smart tactical move.
Interesting. Okay, so tactically adept, but what about communication, transparency? There seems to be a bit of a disconnect sometimes.
Yeah, that's a fair point. While CEO Wheeler and her team project this very consistent, transparent message on earnings calls, disciplined execution, clear plan to profitability.
Right.
There is a disconnect investors should be aware of. Public filings reveal a consistent pattern of insider selling, and crucially, no open market buys from executives or directors in over a year.
Selling but no buying.
Exactly. Both CEO Carrie Wheeler and the Chief Legal Officer Sidney Schaub have sold millions of dollars worth of shares. Now, these are done via prearranged trading plans, 10b5-1 plans, so they're perfectly legal, often part of executive compensation.
But the optics aren't great.
The optics aren't great. This consistent selling from those who presumably know the business best can certainly undermine investor confidence. It raises questions about their conviction in that long-term upside they publicly talk about.
And what about how they're allocating capital? Where's the money going?
Well, historically, Opendoor's capital allocation focused heavily on vertical integration. The big move was the 2019 acquisition of OS National, a title and escrow company, to bring those critical closing processes in-house.
Trying to own more of the process.
Exactly. Currently, though, with the ongoing losses and high cash burn, the focus is squarely on capital preservation and just achieving operational profitability, not really on aggressive new investments or M&A.
Makes sense given the losses.
Yeah. And as an unprofitable growth company, it's no surprise Opendoor has never paid a dividend or done any share buybacks. That recent proposal for a reverse stock split, while framed as being for NASDAQ compliance.
You think there's more to it?
It could also suggest management might be considering a future secondary equity offering to raise capital, which of course would dilute existing shareholders. Something to watch.
Okay, so bringing this together, capital allocation, business model, what does it imply about their efficiency? Let's talk return on invested capital, ROIC.
Right, ROIC, critical metric, measures how efficiently a company uses its capital to generate profits. For Opendoor, its ROIC for the trailing 12 months is, well, it's deeply concerning. It's negative 5.09%.
Negative 5%. Ouch. How does that compare to their cost of capital?
That's the key comparison. Their weighted average cost of capital, or WACC, the average rate they pay to finance their assets, is currently around 10.29%.
So ROIC is negative, WACC is over 10% positive.
Exactly.
Yeah.
The fact that ROIC is not only negative, but substantially below their cost of capital, is a clear mathematical indication that the business, in its current form, is actively destroying shareholder value. It's losing money on the capital it employs, period.
Chapter 3, Financial Analysis. Let's turn now to the hard numbers. These really tell the story of Opendoor's financial health, or maybe lack thereof. As of July 29, 2025, their market capitalization stands at roughly $1.49 billion. What's remarkable, though, is the extreme volatility this number has seen. It surged from under $500 million earlier in the year. Why? Well, what many are calling a meme stock rally.
Yeah, that definitely clouds the picture.
It really does. It clearly shows how much market sentiment, speculation, and not just underlying fundamentals is driving its current valuation.
And if you look at the revenue history, it's not a story of steady, predictable growth at all. It's a dramatic boom and bust cycle, basically mirroring the housing market.
Right.
Revenue exploded in 2021 and early 2022 when interest rates were near zero. They hit a peak of $15.57 billion in annual revenue in 2022.
$15 billion. Huge number.
Huge number. But then it collapsed dramatically as mortgage rates spiked. It fell all the way down to $5.15 billion in 2024. That extreme cyclicality is a core inherent risk to this business. You just can't ignore it.
And the profit margins, I assume they tell a similar story.
They reveal the fundamental economic challenge of this iBuyer model, yeah. Their gross margin for the trailing 12 months is very thin, just 8.16%.
8% gross margin. Not much room for error.
Very little cushion for pricing mistakes, unexpected renovation costs blowing up, or just a downturn in home values hitting their inventory. Then, once you factor in corporate overhead, their operating margin is negative 5.19%.
So losing money on operations.
Meaning for every dollar of revenue, they're losing over 5 cents, even before accounting for interest payments on their debt.
Oof.
And after that substantial interest expense, because they carry a lot of debt, their net margin deepens further to negative 7.18%. It just paints a clear picture. The current business model is not financially self-sustaining.
Okay, what about cash flow? Free cash flow generation must be tricky to analyze here, too.
It's exceptionally volatile for Opendoor, and honestly, it can be quite misleading if you don't look closely. A large negative free cash flow, like the negative $5.83 billion they saw in 2021.
That sounds terrible.
Well, it often just signifies periods of aggressive home buying. They're pouring cash into acquiring inventory, which is their core business. Conversely, a large positive free cash flow, like the $2.31 billion they reported in 2023,
That sounds good.
it can actually indicate rapid inventory liquidation, which often occurs at a loss, reflecting more of a survival strategy during downturns to raise cash quickly, rather than profitable operations.
Got it. So you need context.
Absolutely. And from a traditional value investing perspective, Opendoor also presents this massive red flag. It has never reported a full year of profitability since its inception, not once.
Never. Wow.
Never. Net losses have been persistent through both housing booms and busts. Look at 2022, a boom year for revenue. They still lost $1.35 billion.
Okay, that's stark. What about the balance sheet? You mentioned debt.
Yeah, the balance sheet shows high leverage. Their debt-to-equity ratio is currently 3.92. That heavy reliance on debt to finance operations, it just amplifies their financial risk, especially during downturns, because those interest payments must be made, whether they're profitable or not.
And that ratio has been higher.
It actually peaked at a pretty precarious 4.97 back in 2022 during that crunch. Now, on the surface, the company's current ratio, that's current assets divided by current liabilities, is 2.99.
Which normally looks very healthy, like plenty of short-term assets to cover liabilities.
Right. Superficially, it looks great. But this metric presents, frankly, an illusion of safety for Opendoor.
How so?
Because the quality of that ratio depends heavily on its largest component, real estate inventory. As of the end of Q1 2025, inventory accounted for $2.36 billion of the $3.15 billion in current assets. That's most of it.
And inventory isn't cash.
Exactly. Unlike cash, inventory is illiquid, and its value is subject to rapid market fluctuations. In a sharp housing market downturn, the actual realizable value of that inventory could be significantly lower than what's on the books.
So that seemingly robust current ratio could just evaporate.
It could deteriorate rapidly, revealing a much more fragile liquidity position than it first appears. Big risk hidden in plain sight.
So with all these challenging financials, negative earnings, how do we even begin to value Opendoor? The standard price-to-earnings ratio, PE.
It's useless here. Simply not meaningful because their earnings per share are negative. You can't value the company based on current profits because there aren't any.
Right. So to truly understand Opendoor's intrinsic worth, we have to look towards its future potential, not its past performance. Which brings us to discounted cash flow, DCF analysis.
Exactly. But let's be clear. Conducting a DCF analysis on a company as speculative and consistently unprofitable as Opendoor is fraught with uncertainty. You're making forecasts about future free cash flows, which are highly speculative, and then discounting them back to a present value.
Lots of assumptions involved.
Massive assumptions. But for educational purposes, you can construct a model. And doing so typically yields a really wide intrinsic value range, something like approximately $0.75 to $2.50 per share.
That's a huge range, from 75 cents to 250.
It is, and that wide range itself reflects the high degree of execution risk and the almost binary sort of make-or-break nature of this investment. Will they figure it out, or won't they?
I see some analysts with much higher targets, though.
Yeah, you do see some third-party models projecting much higher values, even over $11 per share sometimes. But these often rely on exceptionally optimistic assumptions, usually about how quickly the housing market will recover and how fast Opendoor can achieve sustained profitability.
So what are the most critical inputs in a DCF for Opendoor, the things that really drive that value estimate?
Two things mainly: the future growth rate and the discount rate. For growth, analyst consensus estimates hover around 10% annual revenue growth for the next few years, tapering off to a standard 2.5% long-term terminal growth rate, basically acknowledging it's a mature cyclical business in the long run.
Okay, 10% growth. And the discount rate, that reflects risk, right?
Exactly. And given Opendoor's extreme risk profile, its high stock volatility, its precarious financial state, a discount rate of, maybe 12% to 15% feels more appropriate than its calculated WACC of 10.3%.
Why higher?
That higher rate better accounts for the significant bankruptcy risk and just the sheer operational uncertainty inherent in their model right now. You need a higher hurdle rate to compensate for that risk.
Part 2. Welcome back to part 2 of our deep dive into Opendoor Technologies. We've dissected the business, the management, the challenging financials. Now let's explore how the broader market perceives Opendoor right now. And honestly, the professional analyst community seems deeply skeptical of Opendoor's recent stock surge. The consensus rating among analysts is a pretty lukewarm hold.
Not exactly ringing endorsement.
No. And more tellingly, the average 12-month price target sits in a range of roughly $1.14 to $1.70, which is substantially below the current trading price of $2.02.
So the pros think it's overvalued right now, basically.
That's what it suggests, that the professional community views the current valuation as kind of detached from the company's underlying fundamentals and the recent media narrative. It's been overwhelmingly dominated by one theme: Opendoor's emergence as a meme stock.
Yeah, you see that everywhere.
Coverage focuses on the extreme volatility, the social media buzz, places like Reddit's Wall Street Bets, and the whole dynamics of a potential short squeeze. The story is less about Opendoor's actual business and more about the speculative trading behavior that's driving its stock price lately.
And a critical factor fueling that speculative frenzy is Opendoor's extremely high level of short interest. Reports indicate that somewhere between 20.7% and maybe even 24% of its publicly available shares have been sold short.
Wow, nearly a quarter of the float shorted. That's huge.
It's very high. It means a significant chunk of investors are actively betting against the stock that its price will go down.
Okay, here's where it gets really interesting, though. That high short interest is the precise fuel for a potential short squeeze, right?
Exactly. That's the dynamic. A short squeeze happens when a rising stock price starts forcing those short sellers to buy back shares they have to close out their rapidly losing positions and avoid margin calls.
And that buying pushes the price even higher,
Creating this powerful feedback loop that drives the price higher and higher, often completely divorced from the company's fundamental performance. The stock has effectively become this battleground between the fundamental bears, who are looking at those weak financials we discussed,
right?
and the momentum-driven retail bulls who are chasing the rapid price appreciation, partly fueled by that short squeeze potential. It's pure market dynamics at play.
Fascinating. What about technical analysis? What are the charts saying?
Well, from a purely technical perspective, the stock is currently showing strong positive momentum. That current price of $2.02 is trading significantly above its 50-day simple moving average, which was around 92 cents. That indicates a powerful short-term bullish trend.
Okay.
And it's also firmly above its 200-day moving average of $1.33. Technical analysts often see breaking above the 200-day as confirmation of a new, potentially longer-term uptrend. So the technicals look bullish, even if the fundamentals look shaky.
Chapter 5. Ownership structure. All right, moving on. Who actually owns Opendoor? Looking at the ownership structure can give us some additional insights into the company's stability and maybe potential future moves.
Yeah, it's always useful to see who's holding the bag, so to speak. Top institutional investors own approximately 49% of Opendoor shares. so nearly half.
Okay, institutions hold a lot. Who are the biggest ones?
If you look closer, the largest stakeholders are those giant passive index fund managers. Think the Vanguard Group holding about 86.2 million shares, and BlackRock, Inc., with around 50.9 million shares.
Vanguard and BlackRock, the usual suspects in passive investing.
Exactly. And a critical point to grasp here is that the prevalence of this passive ownership has an important implication. These large funds, they buy and sell primarily based on whether a stock is included in an index, like the Russell 2000 or whatever, not based on active fundamental research or reacting to company news or valuation changes.
So they're not making active decisions based on Opendoor's performance.
Largely no, which means a significant portion of the shares are held by entities that aren't actively trading based on news or valuation. This can actually reduce the available liquidity in the stock, making the price more susceptible to large swings driven by more active market participants like hedge funds or those individual retail investors we talked about.
Interesting. Less liquidity, more volatility potential. What about insiders, management and directors?
Company insiders, including the executives and directors, own a pretty significant stake themselves, around 13%. CEO Carrie Wheeler herself is one of the largest individual shareholders, holding over 14 million shares.
Okay, 13% is decent alignment. But didn't we talk about insider selling earlier?
We did. And this is where the actions of these insiders, the people with the most intimate knowledge of the business, send a starkly bearish signal, despite their holdings. An analysis of public filings shows the complete absence of any open market insider buying over the past year. Zero buys.
But lots of selling.
In stark contrast, there's been a consistent and significant pattern of insider selling. Just in the last 3 months alone, insiders sold over 829,000 shares. These were executed by top executives through those prearranged 10b5-1 trading plans we mentioned.
So legal planned selling.
Legal planned selling. But still, this relentless selling, even if planned, stands in sharp contrast to the bullish turnaround narrative that management publicly espouses. It's hard to ignore that signal.
Chapter 6, risk assessment, SWOT analysis. Okay, let's try to pull all this together now with a SWOT analysis. Looking at Opendoor's internal strengths and weaknesses against its external opportunities and threats. What are the key strengths?
Okay, strengths. First, definitely brand leadership. They are the most recognized iBuyer brand out there.
First mover advantage paying off there.
Exactly. Second, their proprietary technology. That sophisticated automated valuation model, the AVM, and the vast proprietary data set they've built over years, that creates a significant technological moat it's hard for others to replicate. Third, operational scale. There's at least the potential for real economies of scale in things like renovations, marketing, and transaction processing as they grow.
Potential being the key word.
Potential, yes. And finally, you'd have to say experienced leadership now. The current CEO, Carrie Wheeler, brings those deep finance and operational turnaround skills, which seem crucial right now.
Okay, those are the strengths. What about the weaknesses? These seem pretty significant too.
They are stark and arguably more concerning. First and foremost, chronic unprofitability. That long history of significant net losses means the core business model remains fundamentally unproven as truly sustainable over a full cycle. Second, high financial leverage. That precarious capital structure, heavy on debt, makes them very vulnerable to financial distress if market conditions worsen or rates stay high.
Very capital intensive too, right?
That's the third one. It's an inherently capital-intensive model. They require billions, literally billions, just to fund daily operations and hold inventory.
And that leads to?
That leads to the fourth weakness, the deeply negative ROIC we discussed. The fact that the company is actively destroying shareholder value with the capital it employs right now. That's a major weakness.
Okay, weaknesses are clear.
Yeah.
What about the external environment? Opportunities.
There are some significant opportunities, definitely. First, the sheer size of the massive addressable market.
Yeah.
U.S. residential real estate is a colossal asset class.
Yeah.
Even capturing a tiny fraction more is huge.
If they can do it profitably.
If they can do it profitably. Second, the consolidated competitive landscape. With Zillow and Redfin out of the direct iBuying game, it certainly clears the field for Opendoor and reduces direct competitive pressure. And then there's the really big one, the potential for falling interest rates. That would be the single largest potential catalyst. It would likely reignite housing market activity and simultaneously lower their own capital costs. Huge potential tailwind.
Makes sense. Any others?
Yeah, finally, there's a strong opportunity for expansion of ancillary services, title, mortgage, maybe other things. Those could offer potentially higher margin revenue streams beyond just the thin margins on buying and selling homes.
Got it. Now for the scary part, threats.
Threats are significant too. Top of the list has to be housing market cyclicality. The business is just fundamentally tied to the health of the housing market. A prolonged downturn would severely impact them, maybe even fatally.
Right. Interest rates again.
Tied into that, yes. Then there's regulatory risk. Increased oversight of iBuying practices, or maybe specifically their algorithmic pricing models, could be costly and constrain how they operate.
And technology risk.
Always a risk. Technological disruption. Someone else could potentially develop a more advanced, more accurate valuation technology that leapfrogs theirs. Never impossible.
So connecting this back to the bigger picture, the paramount external threat seems to be interest rates, doesn't it?
It really does. High and volatile rates directly increase Opendoor's financing costs and suppress overall housing market activity. A higher for longer interest rate environment is just exceptionally dangerous for this specific business model. And don't forget, persistent inflation in building materials and labor that also directly increases their renovation costs, squeezing those already razor-thin gross margins.
Can you give us like a hypothetical example of an external threat?
Sure. As a plausible example, imagine the imposition of significant new U.S. tariffs next year on key construction materials, things like lumber, steel, maybe appliances. That would directly raise the costs of the repairs and renovations Opendoor performs on every single home they buy, putting further pressure on their growth margins. Just one example of an external shock they're vulnerable to.
Chapter 7. Conclusion. Okay, so we've covered a lot of ground. What does this all mean for you, the listener, trying to understand Opendoor? We've taken this deep dive. Is it an AI disruptor poised for greatness, or more of a speculative value trap?
Yeah, and the analysis really reveals a company at a critical inflection point.
Yeah.
It presents a starkly divided picture, doesn't it? There are compelling arguments on both sides.
Let's synthesize them. What's the bull case? Why would someone be optimistic?
Okay, the bullish thesis for Opendoor is definitely a high-risk, high-reward bet. It's a bet on a successful turnaround by current management and a strong cyclical recovery in the housing market.
Okay.
Proponents argue Opendoor is the clear iBuyer winner now. They uniquely survived that brutal downturn that eliminated their largest, arguably better capitalized competitors like Zillow.
Last man standing, essentially?
Sort of. They stand as the market leader with a strong brand and that proprietary tech platform in a now consolidated niche. And the total addressable market, as we said, is undeniably colossal.
And the new management.
Under this new, financially disciplined leadership, the company has navigated a near-existential crisis. They aggressively cut costs, stabilized the ship, and are steering the business toward potentially its first-ever quarter of positive adjusted EBITDA. That's a key metric they're aiming for, focusing on operational profitability before financing costs and non-cash items. Crucial for proving the core model works.
So the bull case is basically, the worst is over, rates might fall, and they could take off.
That's the essence of it. If mortgage rates decline, it provides that powerful macroeconomic tailwind. For investors with a high tolerance for risk, the stock's severe decline from its peak could offer potentially asymmetric returns, much more upside than downside from here.
Okay, that's the bull case. High risk, high potential reward. What about the bear case? Why be pessimistic?
The bearish argument is grounded firmly in the company's challenging financial history and the, frankly, structural difficulties of its business model. The core thesis here is that iBuying as an industry might just be fundamentally flawed.
A conclusion supported by?
Supported by the exit of those well-capitalized competitors like Zillow and Redfin. If they couldn't make it work, can Opendoor? That's the question. Opendoor has that long, unbroken history of destroying shareholder value evidenced by consistent net losses and that deeply negative ROIC.
The numbers don't lie.
The numbers don't lie. Its balance sheet is highly leveraged. Its perceived liquidity dangerously depends on the fluctuating value of its real estate inventory. And the business model's extreme sensitivity to interest rates means its fate is largely dictated by the Federal Reserve, not really by its own management team, however good they are.
And the current stock price.
Furthermore, the stock's current valuation appears completely detached from these grim fundamentals. It seems driven largely by that unsustainable meme stock frenzy and the technical short squeeze dynamics we discussed. For the bears, Opendoor is a classic value trap whose current stock price is a speculative bubble just waiting to pop.
Okay, bull versus bear. Where did our valuation analysis land again?
Right, our educational discounted cash flow model, which tries to quantify future prospects but applies a high discount rate for all that risk, suggested that intrinsic value range approximately $0.75 to $2.50 per share.
75 cents to 250. And the stock is currently trading around.
Around $2.02 as of July 30, 2025.
So right near the high end of our estimated intrinsic value range.
Exactly. Which suggests that the current market price might have already factored in a significant degree of success for the company's ongoing turnaround efforts. It may even be pricing in quite a bit of optimism for a favorable housing market recovery.
Leaving little room for error.
It seems to leave little margin of safety for the considerable execution risks and macroeconomic risks that definitely remain. While the stock's short-term momentum is undeniably strong, thanks to those market dynamics, its valuation looks stretched relative to the underlying risks and fundamentals. That upcoming earnings report on August 5th becomes even more crucial. It could potentially validate this nascent turnaround story, or it could reinforce the bearish view that profitability remains an elusive, distant goal.
So what really stands out to you at the end of all this? The key takeaway?
To me, Opendoor represents this fascinating paradox. It's a technology-driven company pitching itself as an AI disruptor, but its fate seems, ironically, overwhelmingly dictated by a very old economy factor: interest rates. The core question really remains: can its AI and technology truly disintermediate the complex, relationship-driven housing market? Or is it merely optimizing, maybe slightly improving, a fundamentally capital-intensive, brutally cyclical business? That's the multi-billion-dollar question.
Well, that was a fantastic deep dive. If you, our listener, found this valuable, please do like and subscribe to the Stock Analytics AI YouTube channel. It really helps us out.
Absolutely. And remember, members get priority deep dives on specific tickers you request, all for just $4.99 a month. Over the next few months, we're actually covering all of the S&P 500 stocks, and members get exclusive priority access to those.
And if you just want a one-off deep dive on a specific stock that's on your mind, just drop us a super thanks on YouTube. We'll get right on it.
Just remember, this analysis was generated by an AI system, us, for educational purposes. It should absolutely not be considered financial advice.
Please always conduct your own research or consult with a qualified financial advisor before making any investment decisions. Your capital is at risk.
Join us next time for another deep dive into the complex world of finance.